Most people think I became wealthy because I started young. And sure, I bought my first stock at 11 years old. But here's the part nobody talks about. 95% of my wealth was accumulated after I turned 50. Let that sink in for a moment. The man the world calls the greatest investor of all time built almost everything he has after what most people consider too late. So if you're sitting there at 45, 50, maybe 52, thinking your financial ship has sailed, I need you to stay with me for the next several minutes, because what I'm about to share with you could very well be the most important conversation you've ever had about money. I've sat across the table from thousands of people, brilliant people, hardworking people, people who built companies, raised families, paid their taxes, did everything society told them to do. And the single most common regret I hear, more than bad marriages, more than missed opportunities, more than wrong career choices, is this: I wish I had started sooner. But here's the cruel irony. The second most common regret, which nobody talks about, is this: I wish I hadn't given up when I thought it was too late. Both of those people are in pain, but only one of them still has a chance. And if you're watching this right now, you're the one who still has a chance. Let me tell you about a man I'll call Robert. Robert worked 30 years as a mechanical engineer in Ohio. Smart guy, disciplined guy, put 3 kids through college, kept the lights on, drove a sensible car, never complained. At 45, he sat down with a financial advisor who ran the numbers and told him, quote, "You really should have started saving more aggressively 20 years ago." Robert left that office and didn't open another financial account for 6 years. 6 years of paralysis because someone handed him a verdict instead of a roadmap. When Robert finally came around to my way of thinking, which I'll get to shortly, he had 11 years to his target retirement age. 11 years. Most people would call that a tragedy. I called it an opportunity. And in a moment, I'll show you the exact calculation that convinced Robert he could still retire a millionaire. A calculation so simple it fits on a single napkin, yet most financial advisors will never show it to you because it makes their services look completely unnecessary. But first, I want to address the noise in your head right now, because I've been in enough rooms to know what you're thinking. You're thinking about your mortgage. You're thinking about whatever debt is sitting in the background of your life like bad wallpaper you've stopped noticing. You're thinking about your kids' college fund, or your aging parents, or the way inflation is making groceries feel like a personal insult every single week. You're thinking about time specifically, the time you believe you don't have. Here's what I want you to understand about time. It is the only asset that cannot be manufactured, borrowed, or recovered. But it is also deeply, profoundly misunderstood by people who are trying to grow wealth. The conventional wisdom says compound interest is a young person's game, that the magic of compounding only works if you have 40 years ahead of you. And that wisdom, that dangerously incomplete piece of wisdom, has caused more financial paralysis than any market crash in history. Here's what the conventional wisdom leaves out. Compounding doesn't just work on money. It works on knowledge. It works on skill. It works on behavior modification. It works on decision quality. And a 45-year-old with focus, intent, and a clear system can compress what would take a 25-year-old 20 years to learn into 18 to 24 months of deliberate action. You don't have the runway of time, but you have something the 25-year-old doesn't. You have the scars. You've been through recessions. You've made bad financial decisions and survived them. You understand risk in your bones in a way that no textbook can teach. You understand delayed gratification because you've practiced it for 2 decades, raising children or building a career or simply getting through the week. The 45-year-old who commits to this journey has a psychological edge that Wall Street will never, ever quantify on a spreadsheet. So let's get specific, because inspiration without instruction is just entertainment. The first thing I want you to understand is what I call the wealth gap problem. At 45, the average American has somewhere between $40,000 and $80,000 in retirement savings. The target, if you want to retire with genuine financial independence, meaning you never have to worry about running out of money, is somewhere north of $1 million. That gap seems insurmountable to most people. It is not. But closing it requires a fundamentally different strategy than the one you would use at 25. The 25-year-old can afford to be patient and passive. You cannot. The 25-year-old can throw money into a broad index fund, set it and forget it, and let 4 decades do the work. That is not your game. Your game is deliberate accumulation combined with intelligent acceleration. Let me explain what I mean by that. I want you to think about your income differently than you ever have before. Most people at 45 are actually at or near their peak earning years. The decade between 45 and 55 tends to be the highest income period in most professional lives. This is not a coincidence. You have the experience, the network, the reputation, and the skills that took 2 decades to build. The problem is that most people at this stage have also built lifestyle expenses that consume every dollar of that peak income. The car upgraded, the house expanded, the vacations got more expensive, the children's activities multiplied. What I'm about to ask you to do is uncomfortable. I'm going to ask you to do the opposite of what your peer group is doing, while the people around you are upgrading their kitchen and buying a second property because they deserve it. I want you to do something radical. I want you to find your number, your monthly number, the precise dollar amount that, if redirected from lifestyle expenses into wealth-building assets, changes your trajectory entirely. For most people at 45 who are serious about this, that number is somewhere between $1,500 and $4,000 per month, not from salary increases, not from a second job, although that helps, from reallocation, from auditing your life and making intentional choices about where your money is going. Now I know what some of you are thinking. Warren, you don't know my situation. You don't know my bills. And you're right, I don't. But I do know human psychology, and I know that almost every time I've sat with someone who tells me they have no room to save aggressively, we find the room within 45 minutes. It's not always comfortable to find, but it's there. And here's something I need you to sit with for a moment, because it's going to change how you think about the next 10 years of your life. If you are 45 years old today and you can consistently direct $2,500 per month into the right vehicles, growing at a realistic blended return of between 8 and 10% annually, which is entirely achievable with the strategy I'm going to describe, you will cross the $1 million threshold in approximately 14 years. That puts you at 59, financially independent at 59, not scraping by, not hoping Social Security covers the gap, independent. If you can push that monthly contribution to $3,500, the timeline shrinks to 11 years. 56 years old and free. That is Robert's napkin calculation. That is the exact math that made him close the laptop he had spent 6 years avoiding and start building. And right now I want you to do something very simple. Pause this video for 60 seconds. Write down 2 numbers, what you currently save each month and what you believe you could save if your life depended on it. The gap between those 2 numbers is your starting point. That gap is not a judgment. It is a map. I know those numbers sound abstract. So let me make them concrete by walking you through exactly where that money goes and why the first vehicle, and the one I want you to maximize before you touch anything else, is your employer-sponsored retirement account. If your employer offers a 401k match and you are not contributing enough to capture every single dollar of that match, you are turning down free money. I've never done that in my life, and I don't recommend you start. The match is an instant return on your investment that no market in the world can consistently beat. If your employer matches 50% of contributions up to 6% of salary, that is an immediate 50% return before your money sees a single day of market growth. Maximize this first. Non-negotiable. At 45, you also have access to catch-up contributions. The IRS, in one of its rare moments of generosity, allows people over 50 to contribute additional money to tax-advantaged accounts beyond the standard limits. At 50, the 401k catch-up contribution limit adds several $1,000s in additional annual contribution capacity. This is the government's way of acknowledging that many people start late. Use it now. Here's the thing about tax-advantaged accounts that most people don't properly appreciate until it's too late. The tax benefit is not a minor detail. It is a core component of your return. When you contribute pre-tax dollars and allow them to grow tax-deferred, you are essentially investing money that you would have otherwise handed to the government. That is leverage, legal, guaranteed leverage that most amateur investors completely overlook while chasing hot stocks. But tax-advantaged accounts alone won't get you to $1 million on a compressed timeline. This is where we layer in what I call the compounding accelerators. The second vehicle is a Roth IRA, and I want to explain why it matters enormously for someone in your position. A Roth IRA grows tax-free, not tax-deferred, tax-free. The money goes in after tax, then every dollar of growth From that point forward, every dividend, every capital gain, every cent of appreciation comes out in retirement without a single dollar going to the IRS. For a 45-year-old building a portfolio over the next 15 to 20 years, the tax-free growth on a fully funded Roth compounds into a number that makes the annual contribution limits look almost misleading in their modesty. If you are over the income limits for direct Roth contributions, which is a problem some of you may have given your peak earning years, there is a perfectly legal strategy called the backdoor Roth conversion. I won't go deep into the mechanics here, but it is worth discussing with a qualified tax professional. And if there is one message I want to leave with you about taxes and wealth building, it is this. The difference between someone who builds $1 million portfolio and someone who accumulates assets that amount to the same number is often nothing more than tax strategy. The math is the same. The outcome is dramatically different. Now, I want to talk about the asset side of the equation because this is where most people at 45 make a critical and sometimes devastating mistake. Conventional financial planning wisdom, the kind you get from the glossy brochure at your bank, will tell you to shift toward bonds and conservative investments as you get older, to de-risk your portfolio, to protect what you have. And if you have what you need, that advice is reasonable. But you don't have what you need yet. You are building, not protecting. And building $1 million portfolio on a compressed timeline while holding 40% bonds is a mathematical fantasy. I'm not suggesting recklessness. I'm suggesting clarity about your actual situation. Your actual situation is that you need growth, and growth over a 15-year horizon comes from equities. The research on this is not ambiguous. Stocks have historically outperformed every other major asset class over any rolling 15-year period. Not every single one, there are exceptions. But as a general principle, equities are the engine. Everything else is the brake. What I recommend for someone in the late start position is a portfolio that is heavily weighted toward broad diversified equity exposure. Low-cost index funds that track the S&P 500 are, in my opinion, the most elegant financial instrument available to the individual investor. Not because they are exciting, they are not, but because they are brutally effective over time while demanding almost nothing from you in terms of complexity or active management. Here's a secret that mutual fund managers have spent billions of marketing dollars trying to obscure. The average actively managed mutual fund does not beat the index over a 10-year period. Not some of them, not most of them, the average. After fees, after trading costs, after all the sophisticated research and highly compensated portfolio managers do their work, the boring index fund wins. I've been saying this publicly since the 1980s. The financial industry has been ignoring me since the 1980s. Your wallet doesn't have to. Before I continue, I need to stop and ask you something directly. If what I've shared in the last several minutes has shifted something in your thinking, if you're starting to see that the late start is not a death sentence, but a different kind of game with different rules, I want you to do one thing right now. Subscribe to this channel and turn on notifications. Because what I'm about to share next is the part that almost nobody in personal finance is willing to talk about. Honestly, there is one mistake nearly every 45-year-old investor makes that quietly destroys wealth from the inside out. Then most people don't realize they're making it until it's already cost them years of progress. That's coming up in just a moment. Subscribe, turn on notifications, stay with me. Now, let's talk about what actually kills most late start wealth building plans. And I'll give you a hint. It's not the market. It's not inflation. It's not the interest rate environment. It's not your income level. It's behavior. I have studied wealthy people for over 7 decades. I have studied people who should have been wealthy and aren't. And the single most reliable predictor of financial outcome is not intelligence, not starting capital, not timing. It's the ability to behave consistently in the face of emotional volatility. Markets go down, they always have, they will again. And when they do, every biological alarm system in your brain will scream at you to sell, to stop the bleeding, to get out before it gets worse. This is not a character flaw. It is evolution. Your brain is wired to treat financial loss as a physical threat, and the fight or flight response it triggers is the same one your ancestors used to escape predators. The problem is that predators don't compound. Markets do. The average investor, according to decades of behavioral finance research, underperforms the very funds they invest in because of this exact problem. They buy when the market is high, when everything feels safe and exciting. They sell when the market drops, when everything feels dangerous and uncertain. They buy high and sell low, which is the precise opposite of every principle that actually creates wealth. And here's the mistake I was referring to, the one that destroys late start portfolios more than any bad stock pick or market downturn ever could. It is not panic selling during a crash, though that is destructive enough. It is something subtler, something that masquerades as responsibility and discipline, something I've watched intelligent, hardworking people do over and over again and never recognize as a mistake until the damage is already done. It is called lifestyle creep. And in a moment, I'm going to show you exactly how it works and why it is 10 times more dangerous for someone starting at 45 than it is for someone starting at 25. I want to give you a reframe that has served me well for decades. When the market drops significantly, and it will, I want you to think of it not as your portfolio shrinking, but as your favorite store having a sale. If you love a particular company's products and you walk past their store and saw a 50% off sign, you would not throw away the products you already own. You would buy more. That is how you should think about market downturns at 45. Every pullback is an opportunity to buy assets that your future self will appreciate at a much higher price. The investors who built serious wealth through the 2008 financial crisis were not the ones who timed the market perfectly. They were the ones who kept contributing through the terror, who bought when buying felt insane, who understood at a deep level that the temporary price of an asset has nothing to do with its permanent value. Now let me talk about lifestyle creep, because I made you a promise and I keep them. Lifestyle creep is the steady, almost imperceptible expansion of your spending that follows every income increase. You get a raise. Within 6 months, you've upgraded something: the car, the cable package, the restaurant frequency, the children's activities. The raise disappears into the expanded lifestyle, and your savings rate stays exactly where it was every single time. For a 25-year-old, lifestyle creep is an irritant. For a 45-year-old on a compressed wealth building timeline, it is catastrophic. Here's why. You are in your peak earning years. Every salary increase from this point forward is a gift, a direct injection of capital into your wealth building timeline. Every dollar of that increase that gets absorbed into lifestyle instead of investment is not just a lost dollar. It is a lost dollar that would have compounded for 15 years. At 8% annual growth, $1 saved today at 45 becomes approximately $3.17 at 60. So when you spend a raise instead of investing it, you are not spending the raise. You are spending every version of that raise between now and retirement. You are spending 3 versions of every dollar. This is why I said lifestyle creep is 10 times more dangerous for the late starter. The 25-year-old has time to recover from it. You do not have the same margin. Every income increase from this point forward must be treated as an investment opportunity first and a lifestyle upgrade second, if at all. Now let me talk about income, because most people treat their salary as a fixed constraint rather than a variable they can aggressively influence. At 45, you are sitting on a platform of skills, relationships, and institutional knowledge that took 20 years to build. That platform has value beyond your current salary. One of the highest return investments you can make right now is in understanding how to monetize that platform more aggressively. I'm not necessarily talking about a second job, although for some people that is exactly the right move. I'm talking about thinking strategically about your current income and whether it is accurately reflecting your value in the market. When was the last time you had an honest, data-supported conversation with your employer about your compensation? When was the last time you tested your market value by interviewing for other positions, not because you want to leave, but because you want to know what you're actually worth? A 10 or 15% salary increase at 45, directed entirely into your wealth building accounts, can meaningfully compress your timeline. The math is simple. The psychology is harder. Because asking for more, changing jobs for more, starting a side income stream, all of these require a belief that your late start does not disqualify you. It doesn't. There is also the question of assets you already own that may be dramatically underutilized. The equity in your home, for example, not to be extracted recklessly. I am deeply suspicious of people who treat their home equity as an ATM. But for some people, a thoughtful refinancing strategy or a carefully structured home equity line can provide capital that, deployed correctly into income-producing assets, accelerates the journey materially. This is not appropriate for everyone, but it deserves a serious, numbers-based conversation with a financial professional who charges by the hour and has no product to sell you. Speaking of income, I want to spend a moment on what I consider the single most underrated wealth-building strategy for people starting late. And that is the concept of an income-producing side asset, not a side hustle in the exhausting hustle culture sense of working 7 days a week until you collapse. I mean, building or acquiring something that generates cash flow with diminishing amounts of your direct time, a small rental property, a dividend-focused investment portfolio that pays you quarterly, a small online business built around expertise you already have, a consulting arrangement that converts your professional knowledge into direct income outside your employer relationship. The reason this matters so much for the late starter is that it creates a second river of capital flowing into your wealth-building accounts. Most wealth-building plans are built on a single income stream, and single income streams are fragile. They are subject to the health of one company, one industry, one set of decisions made by people above you in an organizational chart. A second income stream, even a modest one, generating $1,500 to $2,000 a month, is transformative both mathematically and psychologically, because the moment you have two income streams, your relationship with financial risk changes permanently. You stop making decisions out of fear. You start making them from a position of at least partial abundance. And decisions made from abundance compound differently than decisions made from fear. Now, I want to talk about the debt question, because no conversation about late start wealth building is complete without it. There are two kinds of debt, and confusing them is one of the most expensive mistakes I see people make. There is debt that costs you money, credit card debt, personal loans, high-interest auto loans. And there is debt that potentially makes you money, a mortgage on an appreciating asset, a low-interest student loan from an education that raised your earning potential, leverage on an investment with a higher expected return than the cost of the debt. High-interest consumer debt is a mathematical emergency for the late starter. A credit card charging 22% interest is a guaranteed negative 22% return on every dollar you carry as a balance. No investment portfolio in history has consistently returned 22% annually. Eliminating high-interest debt is the highest return investment available to you, full stop. But the question of whether to aggressively pay down a 3% mortgage at the expense of investing is a different calculation entirely. Historically, money invested in a diversified equity portfolio at 3% interest has generated a positive net return over most extended periods. This is an individual decision that depends on your psychology. Some people sleep better without debt, and the value of psychological peace is real and should be factored in. But purely on a mathematical basis, low-cost debt does not necessarily deserve the same aggressive payoff urgency as high-cost debt. I want to address something that I suspect many of you are thinking about right now. You're thinking about your children, about college funds, about the question of whether you should sacrifice your own financial security to help your kids avoid student debt. I say this with complete respect and genuine compassion because I understand the parental impulse behind it is one of the most human things in the world. But I need you to hear this clearly. You can borrow money for college. You cannot borrow money for retirement. Your children have decades ahead of them to build their own financial security. They have options, scholarships, work study, community college, student loans, military service, employer tuition benefits. So you have one shot at this. And if you sacrifice your retirement security to fund their college education, you will one day become a financial burden to the very children you are trying to help. That is not the gift you intend. Prioritize your own financial oxygen mask first. Let me now talk about the role of professional guidance in a late start portfolio plan, because this is an area where I see people make errors in both directions. Some people never seek professional guidance and end up making costly preventable mistakes, whether in tax strategy, asset allocation, or withdrawal planning. Others hire the wrong professional and pay dearly in fees that compound against them over decades with the same mathematical brutality that investment returns compound for them. The distinction you need to understand is between a fiduciary and a non-fiduciary financial advisor. A fiduciary is legally obligated to act in your best interest. A non-fiduciary, which includes most brokers and many financial product salespeople, is only obligated to recommend products that are suitable for you. Suitable is a very low bar. Suitable can mean recommending the product that pays the highest commission while technically not being inappropriate for your situation. Always work with a fee-only fiduciary financial planner. Pay them directly for their advice. The cost of an hourly or retainer-based relationship with a qualified fiduciary is a fraction of what the wrong product recommendations cost you in fees and suboptimal returns over a 10 or 15-year period. But here is something I believe even more strongly. Education is non-negotiable. You cannot outsource all financial judgment to a professional, no matter how qualified. You need enough understanding of the fundamentals of how markets work, how compounding works, how tax law affects your returns, how fees erode performance to be an intelligent client, not an expert. An intelligent client, one who asks the right questions, who understands the answers, and who can recognize when the advice being given serves your interest versus someone else's. Now, I want to circle back to something I mentioned earlier because I promised to return to it, and I always keep my promises where money is concerned. The psychological dimension of late start wealth building. Because this is, in my experience, where the battle is actually won or lost. There is a concept in behavioral economics called loss aversion, the finding that humans feel the pain of losing something approximately twice as intensely as they feel the pleasure of gaining something of equal value. This asymmetry creates a systematic bias in financial decision-making that costs late starters enormous amounts of money. Here's how it shows up in practice. You have been behind your financial targets for years. You know it. Every time you think about it, there is a low-grade anxiety, sometimes a sharp panic, and that emotional state makes you susceptible to two opposite but equally destructive behaviors. The first is avoidance. You don't open the statements. You don't run the numbers. You don't make the plan, because making the plan means confronting the gap, and confronting the gap is painful. So you remain stuck, not because you lack the intelligence or the resources to move forward, but because beginning means acknowledging how far you have to go. The second is overcompensation. You've spent years being conservative or passive or simply not paying attention. Now, suddenly aware of the gap, you become attracted to high-risk strategies that promise to close it quickly. Cryptocurrency speculation, options trading, hot stocks tips from a brother-in-law. These strategies feel logical. I need to make up for lost time, so I need higher returns, so I need higher risk, but they are statistically disastrous for most people who pursue them. The graveyard of late start portfolio is full of people who doubled down on risk to make up for lost time and ended up worse than where they started. The antidote to both of these behaviors is the same. It is radical, almost boring clarity about what the math actually requires and what system followed consistently gets you there. Not hope, not speculation. A system, write down your target number. Write down your current number, calculate the gap, determine with real data from your actual life how much you can direct toward that gap each month, choose the vehicles, automate the contributions, review quarterly, adjust annually. That's the system. It will not make you rich in 6 months. It will make you financially independent within 15 years with a probability that dwarfs anything the financial entertainment industry is selling. And now, before I give you the final piece of this conversation, the piece that ties everything together, I want to be direct with you about something that I rarely hear discussed in financial content. The $1 million portfolio is not the goal. Financial independence is the goal. The $1 million is a threshold, a number that invested in a diversified portfolio following what is known as the 4% rule can generate approximately $40,000 per year indefinitely without depleting the principal. If your retirement lifestyle requires more than $40,000 per year from your portfolio, your number is higher. If it requires less, your number is lower. The reason this distinction matters is that many people are running toward an arbitrary number, $1 million, $2 million, whatever, without knowing whether that number actually funds the life they want. Before you build the plan, build the picture. What does the retirement life actually look like? Where do you live? How do you spend your time? What does health care cost? What do you want to give to your children or your community? How much do you want to travel? Answer those questions first, and then reverse engineer the number those answers require. You may find that your actual freedom number is lower than you thought, and reaching it earlier than expected is not a problem. I want to leave you with the most important thing I know about building wealth at any age, but especially at 45. Every single day you delay costs you more than the day before. Not because of some abstract mathematical principle, though. That principle is real and significant, but because of something more personal. Every day you live without a clear financial plan is a day you spend in quiet anxiety instead of quiet confidence. And that anxiety compounds just like money does. It shapes your decisions, your relationships, your health, your capacity for joy. The cost of financial paralysis is not only measured in dollars. It is measured in the version of yourself that never gets built because you were too worried about money to invest in anything else. You are 45, maybe 48, maybe 51. You are not finished. You are not too late. The late start is not the beginning of your failure story. It can be, if you choose to make it so, the beginning of the most financially intentional chapter of your life. There is a version of you at 60 that is free. That gets up in the morning and chooses how to spend the day rather than being told. That does not check the bank account before agreeing to attend a family event. That gives generously, travels comfortably, and sleeps without the specific grinding anxiety that financial uncertainty creates. That version of you is not a fantasy. That version of you is a math problem. And math problems, unlike regret, have solutions. The question is not whether you can get there. The question is whether you are willing to make the specific, consistent, unglamorous sequence of decisions that gets you there. Whether you are willing to drive a little less car than your income suggests you could afford. Whether you are willing to have the slightly uncomfortable conversation with your employer about compensation. Whether you are willing to automate the savings before you see the paycheck so that the lifestyle never has a chance to consume what belongs to your future. I've been in this business for over 70 years. I have watched markets boom and crash and boom again. I have watched fortunes made and lost and occasionally made again. And the single thread that runs through every financial success story I have been privileged to witness is not timing. It is not genius. It is not luck. It is the willingness to begin, wherever you are, whatever the clock says, to take the gap between where you are and where you need to be and refuse to let it become an excuse to do nothing. You are watching this video for a reason. You are asking these questions for a reason. That instinct that pull towards something better, something more secure, something that belongs entirely to you, that instinct is the beginning of the system. Do not waste it. If this conversation has been valuable to you, and I genuinely believe it has, because the information I've shared here represents principles I have spent decades refining, then I want to ask you to do two things before you close this video. First, share it. Send it to the 45-year-old in your life who needs to hear that it isn't too late, because the cruelest financial lie in circulation today is the one that tells people the window is closed. It hasn't. Not at 45, not at 50. And the people closest to you deserve to know that. Second, in the comments below, I want you to write one word. Just one word that describes how you feel about your financial future right now. Not how you think you should feel, how you actually feel. I read these comments more than you might expect. And the single most common word I see from people who are 1 year into a serious wealth building plan is different from the word I see from people who are still on the sideline. The people on the sideline write words like scared and overwhelmed and hopeless. The people 1 year and write one word almost universally. That word is finally. I want to see your finally. I want to see this work the way I know it can work. The late start protocol is not a consolation prize. For those who actually follow through, it often becomes the best financial decision of their life, precisely because they made it with the clarity and urgency that only comes from knowing in your bones that time is the one thing you cannot get back. You have enough time. But you do not have time to wait. Start today. Start imperfectly. Start with the number you can manage right now, not the number you wish you could manage. Automate one contribution. Read one chapter of one serious book about investing. Have one honest conversation with your spouse or your financial advisor or yourself about where you actually are and where you actually need to go. One decision, one step, one day. That is how million-dollar portfolios are built. Not in a single inspired moment, but in 1,000 consistent, quiet, unglamorous decisions made by someone who decided somewhere around the age of 45 that the future was still worth building. I've been building mine for over 80 years. I'm still not done. Neither are you.